We think we're going higher, Mandy. We think we're really about to break out here. The market's been sideways for the last 4 or 5 months, worried about things like the dollar, U.S. interest rates, oil, earnings in the first quarter, and the economy in the first quarter. And all those things are now behind us. The oil's stabilizing, dollar stabilizing, rates are stabilizing, bad economy's behind us. And this earnings season has been pretty well forecast to be pretty poor. And so actually, on average, we're kind of beating reduced expectations.
Well, what we would look for are 3 wishes that we have for the results tonight. The first one is that we would want to see AWS be very capital intensive. Our concern about Amazon is that they throw off free cash flow. They have not been doing that lately. If AWS is the source of the cash hog, then we know that the retail business is more cash generative than it appears. So that would be good. The other thing to look for is ad revenue, because inside the same line item that they share AWS revenue shares that line item with advertising revenue. And if AWS gets subtracted out, we can see that ad revenue, and that can give us some new insight into a new profit stream.
I continue to look for a slow recovery. We are still seeing very cautious firms in Europe, particularly in Germany. They've had quite a pickup in private consumption, and exports have been doing okay, and yet we don't see a pickup in investment. So it's really also the corporate sector that's very cautious, but there are reasons to think that in the second half of the year, obviously if we don't have a major accident along the way, investment spending will probably pick up. As long as they don't point to a major weakening, which is not the case at the moment, I would agree with that. Clearly, the biggest drivers of the rally in equities are the ECB policy, the depreciation of the euro, which has boosted the profitability of European companies. Obviously, whether the PMI is 53 or 54 doesn't make a huge difference.